And so inflation is already coming down. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023. And no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think.
Rickards has been called the modern-day Nostradamus for his economic and financial disaster predictions. He is an American lawyer, economist, and investment banker who has written extensively on finance, economics, and geopolitics. There's a lot of talk about inflation these days, but Jim Rickards says we should be more worried about deflation. He believes that a major United States recession is coming in 2023, and it will be worse than a recession. Rickards believes that inflation is coming down, and there's even some danger of deflation, which could cause major economic problems. He believes that the Fed is underestimating the risks of a recession and that a recession in 2023 could be worse than the one we experienced in 2000. According to a November post by Forbes, a recession is very likely in the U.S. future, and although it could be avoided, it is highly unlikely. The post revealed that the recession will begin in late 2023 or early 2024. Welcome back to our channel. In this video, Jim Rickards discusses the current state of the supply chain and its impact on the prices and availability of goods. He also talks about why he believes deflation is imminent, as well as a major U.S. recession which would be worse than what people think. Please watch, like, and share this video. Also, drop your comments and thoughts below. Remember to like and subscribe to the channel for more related content similar to this. We begin with a short clip of Jim Rickards.
This time last year, you'll recall there were headlines, bare shelves, empty shelves, supply chain breakdown, Christmas will be canceled, etc. And it was all true. You went to the supermarket. It didn't mean that every shelf was completely bare, like East Germany in the 1950s. But there, paper goods might not be there, or maybe your favorite kind of tomato sauce, or chicken, or whatever it was. There were some things there, but a lot of things weren't there, and that got worse. And then, of course, gas prices skyrocketed basically because of a lot of bad policy from the United States in terms of Keystone Pipeline and a lot of other factors. That then got worse. It eased up a little bit in the summer, but it never went away. This is a complex system. It was breaking down. That was very clear. And now we're seeing a second wave of that. And I point to, one, I don't want to overuse metaphors, but one metaphor is you have a very beautiful, expensive vase, and somebody knocks it over and it breaks into 5,000 pieces. You can't put the vase back together. You've got to go get a new one. And that's what's happened with the supply chain. What I call supply chain 1.0 from 1989 to 2019 is broken. There will be a new supply chain. There always are. Supply chains have been around since the Bronze Age, if not earlier. But the new supply chain, what I call supply chain 2.0, will look very different than the old supply chain. Right now, we're in an in-between period where things don't work well. Again, it doesn't mean total chaos, but you still see shortages, you still see higher prices, which are coming from supply chain disruptions. And these things are not easy to fix, but they can be replaced, and that's what I expect to happen.
According to Rickards, there were headlines about empty supermarket shelves and supply chain breakdowns last year, which caused concerns about Christmas being canceled. This statement is backed by an August 2021 online news report from Wales Online, which reported that Christmas could be canceled as food supply issues affect supermarkets. According to the Post, the reason behind this was that there was a shortage of lorry drivers available for deliveries. Popular news media The Guardian reported the next month in their headline post stating that Tesco warns of Christmas panic buying if driver shortage persists. These issues were caused by a complex system breaking down, and although the situation improved slightly in the summer, it never completely disappeared. Rickards refers to this as supply chain 1.0 and says that it is now broken. He then went on to say that a new supply chain 2.0, will emerge, and it will look very different from the old one. Currently, Rickards believes that we are in an in-between period where there are still shortages and higher prices due to supply chain disruptions. These issues are not easy to fix, but they can be replaced. Listen to these carefully.
We are at peak inflation. Inflation is going away very quickly, and the Fed moves are working now. It doesn't mean that the Fed won't blunder and make this worse. I think they will. We can come back to that. But okay, so the inflation sort of came on the scene in mid-2021, in the summer 2021. By the fall, it was very high. And this is when Jay Powell was saying transitory, transitory, transitory. By November 2021, he threw in the towel. He said, okay, time to retire the word transitory. And then they started hiking rates in March. On March 1st, the policy rate, the Fed funds target rate, was zero. Today it's 4.25%. It's going to go up another 50 basis points on December 14th. So, and then the next meeting after that is February 1st. So they're going to keep raising over 5, probably get to 5.25%. That's in less than a year. I mean, we've gone to 4.25 in less than 8 months, or just barely 8 months. So, but inflation is already off the top. It's going to come down a lot more. The markets are not ready for that. I see the inflation. I put gas in my car. I go to the grocery store. I see it just like everybody else. Home heating costs, and eggs, milk, bacon, food, gasoline.
Rickards believes that the United States is currently experiencing peak inflation. He mentions the role of the Federal Reserve in raising interest rates and the expected decrease in inflation. He predicts that the markets are not prepared for this decrease and cautioned that the Federal Reserve may make mistakes that worsen the situation. This means that we could see a decrease in GDP growth and unemployment due to a lack of increase in wealth. Investors should be cautious of this, as the effects of inflation are becoming easily noticeable to the general public. The markets have been accumulating a lot of debt for a long time but have been making money at exponential rates. This has led to a lot of expectations from the public that the markets could go up indefinitely. But this slowdown in inflation is a warning to the public that the markets are due for a correction. If the public does not cut their debt or acquire more savings, this will result in a crash. It is not likely that the crash will happen in the next 5 years, but it is definitely possible. Listen to these carefully.
But here's the point, Danielle. There are two major sources of inflation potentially. One is the supply side. So supply shortages, supply chain disruptions, the kind of things we've been talking about. That's called cost push inflation. Costs go up and it gets pushed onto the consumer. The other source is demand, what's called demand pull inflation, which is more psychological. Consumers are thinking about choices and they say, I was thinking about buying a refrigerator. I was going to wait 6 months, but hey, the price is going up. I better go buy it now before the price goes up. In the 1970s, we had both. We started with cost push from the Arab oil embargo, but it flipped into demand pull in the late 70s and it just spun out of control and Paul Volcker had to crush it. Today, the inflation is coming from the supply side. Some of the things we talked about, higher fuel costs. I mean, everything has to be transported, so fuel is part of everything. It gets built into the price of everything. And there are other shortages and bottlenecks and costs that have to be taken up by manufacturers and distributors. So that's real. I'm not saying the inflation isn't real, but it hasn't leached over onto the demand side. The psychology of consumers is not, I better buy it today because the price is going to go up. It's like, no, I better save money today or watch my budget, etc. And here's the difference. Demand pull inflation feeds on itself. The more of it you get, the more of it you get. It does spin out of control. So the cost push inflation from the supply side tends to be self-negating. There's an old saying, the cure for high oil prices is high oil prices. If your SUV or Ford F-150 pickup truck, if you're filling up the tank, went from $75 to $150, which it has, that demand is inelastic. You got to put gas in your car. You got to get to work, take the kids to school, whatever it may be. But that means $75 in my example that you're not going to spend on dinner or a concert ticket or a vacation or a new dress or a new suit of clothes or whatever it may be. So that tends to, and so here's the Fed trying to deal with inflation, but they're dealing with it from the supply side. The Fed doesn't drill for oil. They don't drive trucks. They don't grow crops. They don't have farms, etc. The Fed can't do anything about supply side inflation except destroy demand. But here's the question. How much demand do you have to destroy to control inflation coming from the supply side? The answer is a lot. They're trying to get to a terminal rate. They're already there. They just don't know it. They'll be the last to know. So they're going to take rates to 5.25 or higher by March. But they're already at the terminal rate. They just don't know it. And so inflation is already coming down. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023. And no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think.
According to Rickards, the two primary sources of inflation are the supply and demand sides. Supply-side inflation is caused by shortages or disruptions in the supply chain, which leads to increased costs that are passed on to consumers. Demand-side inflation, also known as demand pull inflation, is driven by psychological factors such as consumers feeling like they need to buy a product before the price goes up. Rickards explained that we did experience both sources of inflation in the 1970s, but the demand-side inflation spun out of control. However, the inflation being experienced currently is mainly coming from the supply side due to factors such as higher fuel costs and shortages in production. He states that the Federal Reserve is trying to address this inflation by raising interest rates. However, to him, inflation is expected to begin decreasing on its own, but the Fed may not realize this and continue to raise rates, which would only lead to a potential economic downturn. That's all for today. In your own opinion, kindly let us know what you think about the question asked by Jim Rickards on how much demand needs to be destroyed to control inflation coming from the supply side. Feel free to let us know in the comment section below. Kindly share this video with your family and friends, and don't forget to hit the like button and subscribe to our channel for more updates. Thanks for watching. Anticipate our next video update.